Welcome to today's class. Today we are going to take another question on analysis and interpretation of financial statements. Shekiri Nigeria Limited is a major competitor to Ejo Ventures Limited. Both companies operate in the same industry in the last 20 years. The summarized financial information of Shekiri Nigeria Limited for the last 20 years are as follows. So we have this. This is their profit and loss, revenue, cost of sales, gross profit, selling, distribution and administrative expenses, interest expenses, net profit before taxation profit for the year, statement of financial position. Okay, let's continue. Then the statement of financial position, we have intangible assets, tangible assets, we have current assets, inventory, trade receivable, bank. We have equity, ordinary shares, retained earnings. We have non-current liabilities, loan notes. We have current liabilities. We have trade payables, other payables. Now, they gave us the financial ratios. The financial ratios were given for 2019 and 2018. They gave us for gross profit margin. They also gave us for ROAS. ROAS is computed as profit before interest and tax all over equity and loan. Then we have net profit margin was also given, asset turnover, gearing ratio, debt over equity ratio, interest cover was also given, current ratio, quick ratio, receivable payment period, inventory turnover period, payable turnover period. Shekiri Nigeria Limited declared dividend of 120 million naira each in years 2018 and 2019 required. As the chief accountant of Ejo Ventures Limited, write a report to your company's finance director analyzing the performance of Shekiri Nigeria Limited, which is your company's competitor. Highlight 5 areas which will require further investigation, including reference to other pieces of information which would complement the analysis of performance of Shekiri Nigeria Limited. Now, the information given here in this question relates to the Shekiri, whereas we are the chief accountant of Ejo. We want to analyze the performance of our competitors, and that will be reported to the finance director. So we'll come back. So we have solution to finance director. So now this is the memo. Since I'm reporting to the finance director, it will be a memo that I will write to my finance director. So the memo will now be to from subject at the right margin, ref, date. Now, I'm writing to the finance director from the chief accountant. The subject is analysis of the financial performance of Shekiri Nigeria Limited. Now, I try to explain. You have to introduce your first paragraph will be an introduction of what you want to do. Now, I introduce it by saying this is a detailed report of the performance of Shekiri Nigeria Limited based on the computed ratios. Based on the computed ratios from their financial statements, and at the end of the report, a recommendation will be made on the areas that need investigation, on the area that need investigation. Now, the Shekiri company, and after analyzing, the second paragraph will now be analysis of profitability. Shekiri company has been successful based on their return on capital employed, which is the most important measure of profitability. ROAS of the company was 21.5% and 17.8% for 2018 and 2019 financial years. Although from the obvious indicator, the ROAS decreased, and this can be attributable to the fact that the company purchased additional non-current assets. How do you know that the company purchased additional non-current assets? Let's go back to the financial statement. This is the tangible assets. It was 200 million in 2018. It is now 240 million in 2019. Now, this is why their ROAS decreased, because the capital employed has increased. As the capital employed increased, probably there was no a commensurating increase in profitability. So that is why there is a decrement in the value of the rules of the company. So as you identify each improvement or a drop in performance, you should be able to know what caused that drop. That is why I took my time at the beginning of the analysis and interpretation of this financial statement as a topic to give you a detailed note and a reliable explanation of how these things happen, what could lead to, and what cannot lead to. I hope that makes sense to you. So we'll go back, and at this level, your interpretation is what gives you higher mark. The computation does not give you mark. I even see I can't give you the computation. Now them by themselves did the computations for you. So they now anticipate that you should interpret these computations. That is the most important thing when you become a financial analyst in a company. These are what you'll be doing. You'll be interpreting figures to your company, and this will save a lot of cost for your company if you can do this efficiently. Now let's go back to the interpretations. Now remember where we were. Good. Now he said purchase additional non-current assets during 2019 financial reporting period. Now that is all. The gross profit margin, you see, I'm still talking about profitability, was on a high side with 34.3 and 35.4 for 2018 and 2019 respectively. This indicates that the cost of sales was 65% and 64.6%, and the company performed very well by pinning down their direct cost within that 1 year. More so, the net profit margin indicated that their overhead costs increased in 2019, and this could be as a result of increase in salary of workers or other operating expenses. Now, if you go back to gross profit margin, now let's look at gross profit margin. You see net profit margin in 2018 it was 12 points. In 2019 it was 11 points. You can see it dropped. So this could be as a result of increments in overhead costs such as salaries and wages, such as other operating expenses. You understand, like cost of running their generator, cost of maintaining their assets, like increase in depreciation due to increase in the value of assets. But so this could be why their net profit margin was lesser. So you can be able to tell management why things are this way. So they don't need to go and call an analyst from outside to come and analyze the financial statement you prepared. So it is not only preparing the financial statement, but can you be able to analyze the financial statement and communicate what they mean and what they imply to your management for their proper understanding. That is that for that. So we continue. So we have asset turnover. Now we have, what is gross profit margin? The gross profit margin was 34% in 2018, but 35% in 2019. You see, it increased. That means we earned more in terms of gross profit margin. Why could this have happened? Because we were able to manage and pin down our direct cost, as the case may be. See, it is important, I will repeat again, for you to master interpretation of financial statement. Once you master this, you are good to go. The computations are not issue. You can do it. It's formula now. Once you remember the formula, you compute. But can you interpret? That is where 70% of the maths lies. Okay, we'll now continue with the interpretation. So we now move to third paragraph. Third paragraph, we'll be talking about efficiency ratios. I told you about the categories of the financial issues and analysis. I said there are five in number. The first one is profitability. The second one is efficiency. The third one is liquidity. The fourth one is solvency. And the fifth one is about investors' returns and all that. So that is that for that. So let's continue. Efficiency ratio of Shekiri indicated how efficient the management was in managing the affairs of the company. The asset turnover ratio indicated that the assets generated 24.3% and 23.6% return in 2018 and 2019 respectively. The time to collect receivable from credit customer increased from 52 days to 64 days, and this shows in their return on capital employed. More so, the inventory holding period increased, and this shows that it takes Shekiri longer time to get their inventory sold, as the case may be. This indicates why there was a drop in the current ratio, and the quick ratio remained the same without a change. Based on the ratio, the working capital cycle increased appropriately, and this shows that the company might be over trading. You see, you can relate this so that as the examiner look at your interpretation, he has no option than to give you your mark. Now, let's go back and exploit this. Looking at this ratio, you will see asset turnover. In 2018, the asset turnover was 20.3. In 2019, it was 23.6. So since it's 24.3 in 2018, you can see that the asset was generating more than 2019. Now, this could be as a result of the increase in the value of assets that we bought in 2019. You understand? Good. Now, looking also at efficiency ratio, you would observe that in 2018, the receivable payment period was 52 days, while it was 64 days in 2019. It increased. That means our credit policy is not favorable. It takes our customer a longer period of time to pay. It takes our customer a longer period of time to pay. You understand? Than before. So, and it is not favorable. It's costing a drop in our liquidity ratio. Also, looking at the next one, inventory turnover period. The inventory turnover period is 171 and 182. Now, it increased also, which shows that it takes us a long period of time to sell our inventory. So, what do we need to improve the sales of our inventory? We need to start marketing. We need to start giving discounts to our customers. We need to start encouraging them to buy more by giving them discounts, and also probably increasing the credit policy, as the case may be. The next one is payable turnover periods, 42 and 46, which is favorable to us. We take a longer period to pay our debts, so it's favorable. We can even negotiate further for them to increase this period of payment. So that is that for that on efficiency ratio that I've explained. So I went back there to draw your mind towards it. The gearing ratio of Shekiri indicates that the company is not highly geared, so it can borrow much more to finance its expansion strategy. More so, more so, more so, the interest cover indicates that the company can be able to meet its finance cost by more than 5 times. So the gearing ratio shows that the company is not highly geared. So let's go back and look at the ratio given to us. These are the ratios. Look at them. You can see the gearing ratio. Gearing ratio it was 24.3% in 2018 and 23.6% in 2019. It reduced because we retired some loan. Let's examine that in the financial statement. You can see loan note. Loan note was 690. Okay, there was an increase in the value of equity, so to say. Look at our equity. It increased from 2,150 in 2018 to 2,230 in 2019. So that is why that our gearing ratio decreased. And this indicates that the company can borrow more to finance its expansion strategy. So the liquidity ratio of Shekiri indicates that the company is liquid because the ratio exceeds the ideal ratio of 2.1 both in 2018 and 2019. So let's look at the liquidity ratio. The current ratio is 2.7 and 2.8, while the quick ratio is 1.1 and 1.1, and it exceeds the ideal ratio. So the company is liquid enough. That is for the interpretation. Now the areas where further investigation can be carried out by our company are long-term loan notes. We need to investigate the time given to them for the long-term note, whether it is 20 years, 10 years, although loan notes can only last for 5 years. So we need to know when they took the loan note and when they are to repay, and the percentage of interest is also important. So we have dividend policy. They have been paying 180 million naira as dividend every year. What is the company's dividend policy? We have different types of dividend policy. So which one do they adopt and why? So accounting policy, what is the accounting policy of the company? Accounting policies differs from company to company. You understand? So what is the accounting policy of Shekiri, as the case may be? So that is that for today's class. So next class we're going to take another question, and that will be Monday, and look at how best to make computation and also interpret. Thank you and have a nice day.